I actually owe over $1.8 million worth of policy loans on life insurance. Why would I do that? There's actually a reason for it. In this video today, I'm going to show you why and actually how it helps me build my wealth over time. I'm going to show you the inner workings of policy loans, how they actually work, so you can determine if it's a good place for you to actually use leverage in order to build your wealth. Now, if you get value from my videos and you haven't already subscribed to the channel, make sure you do so. Hit the bell so you get notified when I put out these videos. It really helps out the channel. And to show my appreciation, in comments that you guys put, I'm going to make sure to get back to them. So any questions you have, put them in the comment section and I will get back to you. So without further ado, let's jump right into it. All right, so let's understand policy loans. What a policy loan is it's using your cash value inside of a properly structured whole life insurance policy. It's using that cash, so you're putting money in as premiums. That money is collateral to get a loan against your death benefit. That's basically what it is. So think about this. Within a life insurance policy, a whole life insurance policy with a mutually owned company, they're guaranteeing you two things. The first thing is they are guaranteeing you that they're going to pay you a certain amount of interest on every dollar that you put inside of your policy, all the premiums. They're guaranteeing that. Now, they're also guaranteeing that when you pass away, doesn't matter when it is, they are giving you a death benefit. So those two things are guaranteed. They know you're going to die at some point. They just don't know when. So the longer you live, the more you put money into a policy, the more they can use it to go make more money in order to pay the guaranteed death benefit. So understanding that is very important. You're putting money into a policy, premium dollars. That money is collateral to go use your death benefit, to leverage your death benefit. So think about like a house. This is a great way to give you like an analogy for it to make sense. If you have a house and you make a payment on the house, so you have a mortgage, right? You make a payment on the house, you're actually building equity in the house, right? So it's the same kind of thing. When you make a premium deposit, a premium payment into a policy, you're building equity. So think about with a house, when you make that payment and you build that equity, you can use the equity. You just have to get like a refinance on your mortgage, or a better option is an equity line of credit. So think about what that is. That is you making payments on your mortgage, building equity, and then using the bank to get a loan, and they use the house as collateral. So they're just letting you borrow from them using your house as the collateral, and you can borrow the equity that you've built, right? Very simple. Most people understand how that works. It's the exact same thing with a policy. You're putting money in, so you're making payments into your policy, just like you're making payments onto your house. You're building equity. The equity is what's called cash value. And as you build that equity, you can borrow up to the equity at any time using your cash as collateral. It's the exact same thing. So again, think about this. You're making house payments on your house. You're building equity. The house is the collateral. Equity is what you can borrow. The bank is giving you a loan using your house as collateral. So again, it's the same thing with the life insurance. You're making premium deposits. You're building equity, which is cash value. Your premium deposits are the collateral to get a loan from the insurance company. The insurance company is just lending you your future death benefit. That's the beauty of it. They're actually letting you use your death benefit while you're alive. So that's what it is at its core. Very simple. Here's the cool thing. There's so many benefits to a policy loan, because think about most loans. Like I just told you guys with the house. If you borrow money from your house, you have to make a payment, right? You have to make a payment with interest on time. If you don't, it dings your credit, right? If you borrow from your house, it goes on your credit, so it affects your debt to income ratio. right? You have to qualify for the loan. So you have to get your credit pulled. You have to show financial statements, tax returns, W-2s, things of that sort. With a policy loan, you don't have to do any of that. You can actually borrow from your policy up to the entire equity, the cash value, at any time, because they know you're gonna die someday. So they'll let you borrow that death benefit anytime because that's something they're guaranteeing you that they'll pay you in the future. So they're letting you borrow the equity of it, the cash value, anytime because it's something they're guaranteeing you, okay? So you don't have to get a credit pull. You don't have to show financial statements. And here's the beauty too. It doesn't show up on your credit. It's a private loan. It's between you and the insurance company. So if you've got a bunch of loans out, like again, I owe over $1.8 million in policy loans. There's nothing on my credit for that. So my debt to income ratio does not get affected whatsoever. If I want to go get a bank loan, it does not affect me from getting loans from a bank. I don't have my credit pulled. If I miss a payment, there's no repercussions. Think about, again, with a regular bank loan, if you miss a payment, your credit gets messed up, you might get whatever you got repossessed, like a car. They might foreclose on a house. With a policy loan, it's an unstructured loan. What that means is that you determine whether you pay the loan back or not. You are in full control of the loan terms. That's the beauty of it. It gives you unhindered control. So think about this, like if you borrow from a policy, you never have to pay it back. You should, but you never have to. Because again, think about what the insurance company is guaranteeing. They're guaranteeing that they're gonna let your money grow at a certain percentage. As of the recording of this video, it's 3.25% with the companies that we use. And they're guaranteeing that they'll pay your beneficiary a death benefit when you die. They know you're gonna die someday. Again, they just don't know when. So if you never pay the policy loan back, they'll just deduct it from the death benefit. They literally have zero risk lending you money of your cash value. Zero risk. Because they know you're either gonna pay it back tomorrow or they just won't have to pay the full death benefit to your family. They have zero risk. And you have all of the control, which is a beautiful thing. So that's, again, kind of the inner workings of policy loans, how they work. You determine the payback period. You determine, if you pay it back, how much you pay it back, and your credit does not get affected. There is no debt to income ratio that goes into account. You never have to make a payment. It's a private loan, so it's not reported to anybody. And you never have to be approved for the loan. If you have cash value, you can borrow it at any time. You actually outrank any place that the life insurance company can invest the premium dollars that go into their general account. Because that's really what they do. You put premium dollars into a policy, they have to take that money and go invest it into very conservative things so that they can make enough money to pay the guaranteed death benefits. They're just banking on the fact that they're going to be able to do that for a long time because they don't think you're going to die soon. They're hoping, and you're hoping as well, I'm sure. So the bottom line is the insurance company knows you're going to die someday. They'll let you borrow the death benefit anytime up to the equity you have in it, the cash value. They'll use your premium dollars as collateral. And if you never pay it back, they'll just deduct it from your death benefit when you pass away. So that's the inner workings of policy loans. Let's jump into why I've got $1.8 million worth of them and what that does for me and how you can possibly mimic what I've done. Let's check it out. All right, so I have borrowed $1,850,000, give or take, from my insurance policy. And this is at 5% interest because the insurance company does charge an interest rate for borrowing their money. Again, you're not using yours, you're borrowing theirs. So they charge 5%. And that's something that doesn't really change very often. Now, that actually comes out to, on an annual basis, if I didn't pay any of the loan back, $92,500 owed to the insurance company. Okay. So what I do is I take that $1,850,000 and I act as a private lender. So I take the money and I lend it to different investors that I've built relationships with. And I have it lent at about 15% interest. I get a lien position, so I don't have a bunch of risk in the deal. I get a personal guarantee. But those are different things for a different video. But I'm lending at 15% using the insurance company's money. So annualized, that comes out to $277,500 earned off of lending that money out. Okay. Now, since I'm not using my money, I'm borrowing the insurance company's money, right? My money is sitting in the policy. Again, it's used as collateral. So it's in the policy earning me interest. It's earning a guaranteed interest of 3.25% plus dividends. Now that comes out to about 5.5% once you add the dividends in. Dividends aren't guaranteed, but the companies have paid them for over 100 years. So they're pretty much a sure thing. So inside the policy, I earn about $101,000 off of my cash value. All right, so what have I done in this situation? I've actually used the insurance company's money to go make me more than what they're charging me. I'm just making a spread on money, on borrowed money. I'm borrowing from an asset, life insurance policy, that is guaranteed to grow. So I'm able to keep borrowing more because it keeps going up in value. So if I take $1.85 million and it makes me 15%, by lending it to different investors as a private lender, I'm making $277,000 outside of the policy. Now that $1.85 million is still in the policy. Again, I'm not using my money. My money is the collateral. I'm borrowing the insurance company's money, my future death benefit that they're guaranteeing to pay me at some point, or I should say pay my family at some point. So I'm actually making, again, $277,000 change outside the policy. Inside the policy, I'm making about $101,000 tax-free. So altogether, $379,000 is my gross gain on this deal, what I'm doing. Now, the only money that I'm actually using, because again, my money is sitting in the policy. It's just sitting there guaranteed to grow. It's kind of like a savings account. It's just sitting there, it's growing, and it's becoming bigger and bigger and bigger. The only money I actually have in this situation that I'm using is the interest that I pay to the insurance company. So think about it. I take their money to go make more. So I'm making altogether $379,000, and it's only costing me the interest that they charge, the 5%, which comes out to about $92,000. So essentially what I'm doing is I'm turning $92,000 into $379,000. That's a 244% cash on cash return. That's the power of using policy loans. As I said earlier in the video, all the benefits with policy loans. I don't have to pay those policy loans back. I do. I constantly flow money back to policies because with policy loans, when you pay them down, you pay less interest to the insurance company. So the actual spread on the money you're making gets bigger because you're paying down the balance. It's a simple interest loan. So as you pay the balance down, your spread goes up because the amount of interest, that $92,000, is actually less because you're constantly paying down that balance. So you never have to pay back the loans, but you should. You're paying down the balance, lowering the interest owed to the insurance company. And here's the cool thing. You're storing money in your policy. As soon as you pay back a policy loan, you can use that money again with no credit checks, no financial statements required. So if you need money for an investment, if you need money for a down payment on a house, if you need money for whatever, you can go get it from your policy with no questions asked. So you're just storing capital inside of a policy where it's protected against lawsuits and judgments in most states. And also, you're giving yourself a place to store money that it's not touchable through judgments, lawsuits. It's a private contract. So that's why you should pay down policy loans. You don't have to, but you should. Also, because when you pass away, if you pay down those policy loans, your family gets the full death benefit instead of the death benefit minus all the policy loans. So hope you guys got value from this video. If you did, make sure to share it with other people that it might help. And any questions you guys have, like I said, I will make sure to answer them. Until next time, I love you guys. Peace.